Understanding different types of investments. So let's start with ETFs. An ETF is an exchange traded fund, which is basically a pooled investment that operates much like a mutual fund. A typical ETF tracks a specific index, sector, commodity, or other asset. But unlike mutual funds, an ETF can be purchased or sold on the same stock exchange that regular stocks are listed on. The structure of ETFs can vary from tracking the price of a single commodity to tracking a broad array of securities. Some can even be structured to track specific investment strategies. Now, in addition to this, there are different types of ETFs you can invest in. Bond ETFs provide investors with regular income. The amount of income they receive is dependent on the performance of the bonds they hold. There are government bonds, corporate bonds, municipal bonds issued by states and municipalities. A bond ETF does not have a maturity date like its underlying instruments. Prices of a bond ETF tend to be higher or lower than the bond prices themselves. Stock ETFs track an entire industry or sector by holding a basket of stocks. Examples include ETFs tracking the automotive or foreign stock markets. In this scenario, high-performing companies and newly entrants with potential for growth will be included in a single industry for diversified exposure. In contrast to mutual funds, stock ETFs have lower fees and do not involve ownership securities. A sector or industry ETF focuses on a particular industry or sector. Companies operating in the energy sector will be included in an energy sector ETF. For instance, by tracking the performance of companies operating a given industry ETFs aim to provide exposure to the upside of that sector. In recent years, funding has poured into the technology sector due to the fact that ETFs do not require direct ownership of securities. The downside of volatile stock performance is also curtailed. During economic cycles, ETFs can also switch between sectors. Commodity exchange traded funds invest in commodities on the exchange market, including crude oil or gold. These ETFs offer a number of advantages. They may help to hedge downturns by diversifying a portfolio. Commodity ETFs, for instance, can provide a cushion during a market slump. It's also cheaper to own commodities through a commodity ETF than it is to own them physically. Why? This is because the former requires no insurance or storage. Currency ETFs, an ETF which tracks the performance of currency pairs, is a pooled investment vehicle that includes both domestically and international traded currencies. Currency ETFs have several uses based on political and economic developments for a country. They can be used to speculate on currency prices. Exporters and importers also use them as a hedge against volatility in forex markets or to diversify their portfolio. They may also be used as a hedge against inflation. You can even invest in Bitcoin ETFs now. Inverse ETFs. Through shorting stocks, inverse ETFs try to earn gains from stock declines. A short position involves selling a stock expecting its decline in value and then repurchasing it later at a lower price. This process is called shorting a stock with derivatives. These bets are essentially against the market. Inverse ETFs increase by a proportional amount when the market declines. The majority of inverse ETFs are exchange-traded notes or ETNs rather than true exchange-traded funds. In a nutshell, ETN is a bond that trades like a stock and is backed by an issuer, such as a bank. If you're uncertain whether ETNs are suitable for your portfolio, I recommend you speak with a licensed financial advisor. Leveraged ETFs. The objective of a leveraged ETF is to return some multiple, for example 2 or 3 times, on the return of an underlying investment. A 2 times leveraged S&P 500 ETF is expected to return 2% if the S&P 500 rises 1%, and will also lose 2% if the same index falls 1%. Options and futures contracts are used in these products to leverage their returns. In addition, inverse leveraged ETFs seek an inverse multiplied return. Okay, so that covers ETFs. Don't be afraid to go back over sections of the video if you feel you needed some more clarification. Now, stocks. Stocks are typically thought of when people think of publicly listed shares traded on exchanges. It is crucial, however, for investors to know about the different types of stocks that are available to recognize their unique characteristics and also to recognize when they may represent a suitable investment. Common and preferred stocks. Usually referred to as ordinary shares, common stock represents partial ownership in a company. Dividends are usually paid by this stock class to investors. Corporate policies are voted on by stockholders who elect the company's board of directors. A company's creditors have the right to assets of this stock class in a liquidation event, but only after preferred stockholders and other creditors have been paid. Most companies issue common stock to employees and family members. By contrast, preferred stock or preference shares entitles the holder to regular dividend payments before dividends are paid to common shareholders. If the company dissolves or goes bankrupt, preferred shareholders are also repaid first. Investors seeking passive income can choose preferred stock, which does not carry any voting rights. Common and preferred stock are both offered by many companies. A parent company of Google, Alphabet Inc., links Alphabet Inc. As its common Class A common stock and Alphabet Inc. as its preferred Class C stock on its website. Growth stocks versus value stocks. A growth stock refers to an equity that is expected to grow faster than the broader market. When interest rates are low and the economy is expanding, growth stocks tend to outperform. A robust economy and access to cheap funding have fueled technology stocks' impressive performance in recent years. Growth stocks can be monitored by investing in the SPDR portfolio S&P 500 Growth ETF, which tracks the SPDR portfolio S&P 500 Growth Index. By contrast, value stocks typically trade at a discount to what a company's performance suggests, and tend to have better valuations than the broader market. During periods of economic recovery, value stocks tend to outperform because they usually generate reliable income streams. The SPDR portfolio S&P 500 Value ETF can be added to your watch list to track value stocks. Income stocks. The definition of income stocks is equities whose dividends are higher than the average dividend of the market and distribute a company's profits. Usually these stocks are less volatile, have less capital appreciation than growth stocks, thus are more suitable for investors wanting regular income. Amplify High Income ETF provides access to income stocks. Blue chip stock. The definition of a blue chip stock is a well-established company that has large market capitalization. Historically, they have delivered dependable earnings and led within their market or industry. Blue chip stocks may be top weight heavy in conservative portfolios, particularly during times of uncertainty. A few examples of blue chip stocks include Microsoft Corporation, McDonald's, or ExxonMobil. IPO stock. An IPO, initial public offering, is when a company goes public. A discount is usually attached to an IPO stock before it is listed on the stock exchange. Investors may also be able to vest their shares so they don't sell them all at once when the stock starts trading. Many commentators refer to newly listed stocks as IPO stocks. The Nasdaq website allows investors to keep track of upcoming IPOs. Penny stocks. Stocks worth less than $5 are considered penny stocks, which are considered highly speculative. Even if some penny stocks are traded on major exchanges, many trade through the QTCQB, a middle over-the-tier counter market for US stocks. When buying and selling penny stocks, investors should consider using limit orders because the bid and ask are frequently very far apart. After the movie The Wolf of Wall Street, a movie about a former stockbroker who operated a penny stock scam, penny stocks shot to popularity in popular culture. The iShares Microcap ETF is a good bet for investors looking to place a bet on penny stocks. Bonds. What are bonds? Fixed income instruments represent loans made by investors to borrowers, generally corporations or governments. The bond could be seen as an interpersonal agreement or IOU between a lender and a borrower that provides the details of the loan and its payments. Governments, municipalities, and states use bonds to finance projects and operations. And issuers' bondholders are creditors or debt holders. A bond's details indicate when the principal will be paid to the bond owner and what type of interest payments the borrower is required to make. The issuers of bonds. In order to borrow money, governments at different levels and corporations often use bonds. Developing a road network, a school, or a dam is a government responsibility. Fundraising may be required due to the sudden costs incurred by war, for example. Corporate borrowing is also common, so businesses can expand, purchase property and equipment, engage in profitable projects, or conduct research and development on new projects, or hire more employees. In large organizations, the problem is that they typically need far more money than conventional banks are willing to provide. Individual investors can become lenders by purchasing bonds, thus providing a solution. Many investors lend portions of the required capital through public debt market. The market allows lenders to sell their bonds to other investors or to buy bonds from individuals a long time after the original issuer raised funds. But how do bonds actually work? In addition to stocks and equities and cash equivalents, bonds are one of the most commonly known asset classes to individual investors. Bonds issued by corporations and governments are usually traded publicly, while others are traded only over the counter or privately between the borrower and lender. In order to fund new projects, run operations, or refinance existing debt, companies or other entities may issue bonds directly to investors. In addition to the loan terms, the bond includes an interest payment schedule and the time by which the amount or the principal must be repaid. In return for lending their money to the issuer, bondholders receive interest payments. These are called coupons, and the coupon rate determines the rate at which the interest payments are made. Initial bond prices are generally set at par or at face value of $1,000 per bond. Accordingly to the market price of a bond will depend on a number of factors, including the credit quality of the issuer, the remaining time until the bond expires, and the coupon rate compared to the general interest rate environment at the time. Upon maturity, the face value of the bond will be repaid back to the borrower. It is usually possible for bondholders to sell their bonds to other investors after they are issued. A bondholder is not required to hold the bond to its maturity. Bonds can also be repurchased by borrowers if interest rates decrease or if their credit rating has improved, which allows them to issue new bonds at a lower cost. The categories of bonds. Companies issue corporate bonds. It is more common for companies to issue bonds rather than seek balance loans to refinance debt, since bond markets offer more attractive terms and lower interest rates. States and municipalities issue municipal bonds. Investors can earn tax-free dividends from municipal bonds in some cases. Bonds issued by the federal government, such as those issued by the US Treasury. Treasury bonds with a maturity date of 1 year or less are called bills. Treasury bonds with a maturity of 1 to 10 years are called notes. And treasury bonds with a maturity rate of more than 10 years are called bonds. Government treasury bonds can be referred to as sovereign debt, as well as treasury bonds issued by government treasuries. A government-sponsored bond is one that is issued by a government agency, such as Fannie Mae or Freddie Mac. Thanks for watching today's video, guys. This is actually a clip from my Investing 101 video. So if you wanted to see that whole video, click down below to see that now. And don't forget to subscribe and like today's video. Thanks very much.